Growing a successful business has never been easy. But whether you're navigating a complex industry or trying to reinvent one, our breadth of banking experts are here to collaborate on market-proven solutions. At KeyBank, we're built to grow with your changing needs because we're not just here for the business you are now, we're here for the business you'll become. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
Are your ad campaigns lighting up the dashboard, but not the pipeline? That's bullspend, and marketers are calling it out in Dashboard Confessions.
My boss asked for results, so I opened my dashboard for the only positive-sounding metric I had: impressions.
Cut the bullspend. See revenue, not just reach. LinkedIn delivers the highest return on ad spend of major ad networks. Advertise on LinkedIn. Spend $250 on your first campaign and get a $250 credit. Go to linkedin.com/campaign. Terms and conditions apply.
Welcome back to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. This week on the podcast, we are going to review shares versus stock options. Before we get into that, let's go ahead and review what took place in the market last week. Last week, we had a short week. On Friday, we observed Juneteenth. Dow Jones increased by 0.7% for the week. The S&P 500 was also positive, closing at 0.9% for the week. For the S&P 500, this was the 11th winning week in 12 weeks. NASDAQ was up 2.4% for the week, making it the strongest of the three. It came back, of course, because of the chip stock narrative. Dominating the news in last week's headlines was the very first meeting of the new Fed chair, Kevin Warsh. These meetings are always hyper-analyzed. Given that it was Kevin Warsh's first meeting, they were extra scrutinized as they were trying to see how he would conduct himself as the new Fed chair, any signals that they were anticipating. We have positive news. It sounds like Kevin Warsh is not going to do what the president asks him to do. In fact, we have received signals that Kevin Warsh is hawkish. When you hear the term hawkish, that just means that he is feeling negative about the market. When a Fed chair is feeling positive, we call that dovish, being a bit more softer towards the market and the outlook. So I think it was really great to see Kevin Warsh stand his ground and potentially do what is right for the economy and not necessarily what Trump thinks is right. Fed Chair Warsh decided to hold the rates steady at 3.5% to 3.75%, so there was no change this month on interest rates. He did decide that he was not going to give his contribution to the dot plot. What's the dot plot? 4 times a year, the Fed releases something called the Summary of Economic Projections. The dot plot is one piece of that. Picture a chart. The vertical line is interest rate levels. Each of the 18 Fed officials places one dot showing where they personally think rates should be at the end of this year, next year, and further out. Nobody's name is on their dot. It's anonymous on purpose. So you see the spread of opinion without knowing exactly who thinks what. Investors and analysts tend to obsess over this because it's the closest thing to peek inside the Fed's head. If most dots drift higher, the market reads rate hike is coming. If the drift is lower, then analysts and investors think cuts are coming. The dot plot started in 2012 under the Fed chair Ben Bernanke. The idea was to have more transparency over the 2008 financial crisis. Over time, it became a market-moving event. Traders would pay attention to what was taking place and make trades on stocks and bonds within seconds of the dots dropping. A lot of critics have said over the years that the dot plots give a false sense of certainty. These are just guesses, not promises, and the market does react to them as if it is a certain roadmap for where interest rates are headed. Warsh not contributing to the dot plot is a really big deal because he's the first Fed chair or person at all since this has been implemented to refuse to participate. However, it is not different from who he is at his core. He has been very critical of this exercise. For some analysts and investors, this is alarming, as Fed Chair Warsh said that he and his colleagues will be moving away from forward guidance. The dot plot projected from 9 out of 18 officials that there would at least be one rate hike this year, and 8 officials said that rates would hold steady, and one of them predicted that there would be a single rate cut this year. Now, most analysts and investors said that this dot plot didn't even matter because it did lack the contribution from Kevin Warsh. The story, of course, that is still being discussed in the market is the SpaceX IPO, one of the biggest IPOs in stock market history. The stock did dip below the open. So right now, if someone purchased shares at the open of the IPO, they are somewhat underwater. The stock is down 2.3% from its opening day as of the recording of this episode, and almost 25% down from its all-time high. Now, as we discussed in the episode a couple of weeks ago, this is to be expected. This is why there are so many warnings against purchasing a stock during its opening week. Let's dive right into this week's episode, the difference between stock options and shares, and then, of course, what different stock options are offered, because there are many different options that are offered if you are working for a publicly traded company or a private company that offers equity. So that we are really clear on this week's episode, let's go ahead and talk about what a share is, also known as stock. Shares are tiny pieces of ownership in a company. If you own a share, you own a slice of a company, and you are technically part owner. The most common analogy we hear is owning a slice of a pizza. Let's say that you own one slice out of 100 slices, then you own 1% of the pizza. If the entire pizza becomes more valuable, then your slice is also more valuable. And in some cases, a company will also grant you some additional cash for being a shareholder, for owning a slice of the pizza, and this cash is known as a dividend. The cash payment for dividends comes from the profits of the company. Stock options. Stock options are not shares. A lot of the time, folks will get confused between the difference in stock and stock options. They are not the same. Let's look at an option as if it was a coupon. It gives you the right to buy a share later, and that share price is locked in at the price when you received the coupon. So let's say that the coupon says you can buy a slice of pizza for $1, and then time goes by and the pizza slices are now selling for $50. You have the option to exercise your coupon, to cash in your coupon, and purchase the share for $1. On the other hand, if the slice of pizza is selling for 90 cents, then your coupon is worthless and you'd never use it. Why companies, most especially startups like SpaceX, hand out these coupons. The biggest reason they hand out stock options is because they are short on cash. Remember, all the cash that they are raising and borrowing is cash that is going back into their own technology. A lot of the times, salaries are one of the biggest expenses, most especially in a tech company, because it requires people that are highly skilled, and there's a lot of competition between tech companies in acquiring these types of employees. And so it is less expensive to offer these employees options. It also gives them ownership in the company, and it helps drive the impact because you own a piece of the company. You want your contribution to the company to help excel the company, because that would mean that in the future, your sweat equity would have paid off much more than if you were getting a paycheck now. The important caveat here is that an option is really a bet on the future. This is a startup company, and so there needs to be conviction on your part if you decide to take on stock options that you believe in the leadership and where the company is headed. You have conviction that the company is going to succeed and that your effort in the company is going to pay really well and potentially convert into something that is life-changing.
Study and play come together on a Windows 11 PC. And for a limited time, college students get the best of both worlds. Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Where is Daredevil? I'm right here.
Don't miss the return of Marvel Television's Daredevil Born Again.
So what's next?
I feel liberated.
We're gonna take this city back.
Over medicated.
In an all-new season, now streaming only on Disney+.
They're hunting us. It's time we started hunting them.
I can work with that.
This should be tons of fun.
Marvel Television's Daredevil Born Again, now streaming only on Disney+.
When SpaceX filed, their S-1 form disclosed the different types of stock options that were available to employees. We're going to go ahead and cover all three of those types of options. The first one we are going to review, same one we've been covering, is the stock options, which we use the analogy as a coupon to buy later. An option is the right to buy a share at a locked-in strike price. Strike price is what we called the price of the coupon. So in our analogy, we said that you will have a coupon that says you can purchase the slice of pizza for $1 no matter how expensive the pizza gets. That $1 value is known as the strike price. SpaceX granted these stock options as its Class C common stock. What does that mean? It means that that stock has absolutely little to no voting power. So normally when you purchase shares in the public market, you and I as a retail investor, we have voting power with our shares. In this case, these stock options are Class C common stock, which are very clear in saying that you have no voting power, no control over the direction of the company. These are the type of stock options that are given in the beginning because you don't want for employees that may be quote unquote random and not have the vision of the company to hold some sort of power. It's basically a powerless ownership of the company with no control. This makes sure to protect the founders and the early investors in the control or the direction that they have for the company. There are two types of stock options that are granted. The first type is called NSOs, non-qualified options. This means that when you exercise, in other words, when you cash in, the gap between your strike price and the current value is taxed right away as ordinary income. So let me rephrase that. The gap between your strike price, using our analogy, the strike price is $1. So let's say the gap between the $1 price and the price that it is currently valued at, $50, you will be taxed right away as ordinary income, okay? When you invest, there are two different types of tax categories. There is the first one, which is earned income. It's the same tax bracket that you currently sit at. However, your investments can put you in a bigger tax bracket. You are taxed as if it was earned income. When you are a long-term investor and you have held a share for more than 12 months, then that is called capital gains, and you're taxed on capital gains, which is much lower than what you would have been taxed in comparison to earned income tax. So let me repeat that. When you exercise or quote unquote cash in this coupon, you are going to be taxed by the gap of the strike price and the current value. So you are going to be taxed on that $49 difference between the $1 strike price and the current value of that slice of pizza, which is $50. That is the NSO, or the non-qualified option. Now we also have ISOs, incentive stock options. The ISOs do not trigger regular income tax, but it can trigger AMT, which is alternative minimum tax. This is a parallel tax that catches that quote unquote paper gain, the payoff you hold, long enough for qualifying disposition, more than 1 year after exercise and more than 2 years after the grant date. The whole gain can be taxed at the lower long-term capital gains rate, which makes it more appealing than the NSO. The biggest takeaway here is that the NSO you pay more taxes on, and the ISO you pay less taxes on. So if you had to choose from one of the two, the best option would be the ISO. However, both are incredible options and could be life-changing. At Netflix, I received the NSO stock options, and it still completely changed my life. If you have stock options, it's best to identify whether you have ISOs or NSOs. The answer to that is going to be in your grant paperwork. This way you can set up a game plan to how you are going to optimize, lower as many taxes as you can. You can put together a strategy with your CPA. A lot of the times people become afraid of even acquiring stock options because of the tax implications, but the tax implications always override the amount of money that you are going to receive. In order to make money in this country, there will always be tax implications. And I think it's important for us to try and move past the idea that you don't want to make money because of the taxes that has to be paid. This is the difference between acquiring more money and acquiring less money. You have to pay taxes on both either way. You might as well acquire more money. I do want to warn you, do not just blindly exercise your options. Please have a CPA review it, because all options have completely different quirks. Sometimes you have to pay taxes up front. A lot of people don't know that. So it's really important that if you have options and you're ready to exercise, make sure that you enlist a CPA to help you understand what you have. That was the review of stock options. Now let's take a look at something else that is offered, known as a RSU, restricted stock units. RSUs are the promise to give you actual shares once the company vests. So there's no strike price, no buying. You are just given the shares. Those are just yours once the company vests. For tax implications, let's say that the company has vested and you decide that you are going to sell your shares at the time that they have vested. Then you will pay ordinary income tax for the shares that you hold. However, if you keep the shares and the price of the share goes up even further, then that extra gain is the capital gains, and you will be taxed as if it was a capital gain and not ordinary income tax. If you are going to hold RSUs after the company vests, then it's really important that, of course, like anything else, you believe in the upside of the company. You believe that they are going to grow in value. A lot of the times people will treat their RSUs like a cash bonus. I think it's really important to assess the company, see where they are headed, and see if you believe in their expansion. Aside from RSUs and stock options, you also have Employee Stock Purchase Plan. Now, that is also known as ESPP. The Employee Stock Purchase Plan is a program that lets you buy company shares at a discounted price using your own money from your paycheck. So let's say you get your paycheck bi-weekly, then you would use a portion of that money to go straight into buying shares of the company that you work for. This means that these shares are not free. You have to purchase them, but you are given the incentive that they are sold to you at a discounted price. That was the program that I was under when I worked at Netflix. Netflix did not give me my options free. I had to purchase my options. They were NSO options, which was fine with me, but at least I got to purchase them at a discount. This was me believing in the future of the company, which is why I decided to make the investment. And of course, that paid off. So if you have ESPP at your company, then definitely consider, if you believe in the future of the company, to purchase stock at a discounted price. ESPP has been an excellent wealth builder for so many people that work in tech companies. And of course, same as the taxes, it depends on what type of options or shares they are allowing you to purchase under this plan. It will vary from company to company. I want to explain to you the difference between vesting and exercising, because a lot of the times we use these two words interchangeably. Sometimes I even do that. It's common to do so, but it's really important to understand the difference between the two. Vesting is that you don't get all of your options on day one. They unlock over a period of time. And so there's sometimes an incentive to stay in when you're vested over a period of, let's say, 4 years, because if you leave too early, then you may walk away from the options. And if they're unlocking over a certain period of time, then you have had the benefit of those stocks unlocking and sort of protecting you from cashing out too early. And then, of course, exercising is the act of actually cashing out and using the coupon. So paying the strike price, paying what the coupon gave you, and turning it into a real share. Until you exercise, you don't own anything. You just hold the right to buy it in your portfolio. Even though you don't own anything, it's still valuable. It's still your portfolio, and it's still treated as if you own something. You could still use your portfolio as collateral to borrow money for a house or to borrow money for a car. It is still part of your net worth. A lot of the times people say you don't own anything yet, but You almost kind of do. It's murky because when people look at your net worth, they count that as you owning something. However, you just haven't physically cashed out on it, and there is the risk that it may lose its value. I don't want this episode to turn too dense because there's so many caveats and things to take into consideration. I really just wanted to create a high-level understanding of the different types of shares and options and incentives that a publicly traded company or a privately traded company can offer their employees. It's going to be really important to understand the different types of options and the caveats and the rules that the company has set up. Every single company is different, so please make sure that you are speaking to a CPA. The only last thing that I do want to sort of flag for anyone that is in this position is that there are two ways to cash out. You can either purchase more shares or you can just take the cash. There is an option one that is called buy and hold, which means that you took that coupon and used it to actually purchase the shares and become the owner of the shares. However, there is caveats to this, and there is nuances that you have to take into consideration, which is the upfront taxes that you have to pay depending on how much the value of the share increased from the time that you got the option. So please take that into consideration. You can also just take the cash now, which is called cashless exercise, and just sort of sell the coupon. You sell the $1 coupon that is now worth $50 at a $50 value, and you get that difference in price. You still have to pay taxes, but at least you don't have to pay upfront taxes. There is pros and cons to both of these options. I did not purchase the shares for my personal options at Netflix. I did not do the buy and hold, exercise the shares and then keep them. I just did the cashless exercise. We looked at it backwards and forwards, and for me, that was the right decision at the time, especially given how much my stock had grown over the years. So I just want to go ahead and throw that out there as a flag. Thank you so much for listening to this week's episode of Investies. I'm your host, Linda Garcia. Investies is a Cosmic Standard production. A very special thank you to the team, Crystal Patino, Asia Simpson, Eliza Smith, and Jacob Winnick. Everything you hear on Investies podcast is for informational and educational purposes only. Nothing on this show is financial advice, and nothing should be taken as a recommendation to buy or sell an investment. Always do your own research before making any investment decisions. I am not a financial advisor.
Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.